Okay, thanks for joining us again. This is Jason Watt from the Business Career College, and we're going to look at mutual funds in a little bit more detail here. So we've already looked at the basics of mutual funds. What I'd like to look at now is some information around the accumulation and taxation components of a mutual fund. So we know that the fund might hold different types of investments. It might hold some stocks possibly, and some bonds. And in fact, with a balanced fund, which is a very common type of mutual fund sold in Canada, it's going to hold a combination of stocks and bonds, probably about 60% stocks and about 40% bonds. And stocks, we know, generate a couple different kinds of returns for their investors. They generate dividends, and they have the possibility of generating capital gains or capital losses as well. Bonds, on the other hand, have the potential to generate interest income, really a coupon, which is going to be taxed as interest, or they also generate sometimes capital gains, and again, capital losses are possible with bonds as well. So our investor invests some amount into this bond. And it doesn't have to be a large amount, but whatever the amount is, it's not really that important. That is what we're going to call the adjusted cost base, or ACB. And you'll remember from the discussion around capital gains that the ACB provides the basis for determining any tax consequences that will then arise for the investor. So from that point, hopefully, what we're going to get over time here is some capital appreciation. That is, we're hoping that this investment grows in value and that you end up at some point better off than where you were when you started. It doesn't always work like that. There's no guarantee of that with most types of investments, and with mutual funds, that's not a guaranteed thing, but that's hopefully what does happen for this investor. So where does that return come from? Well, what's happening here is whatever investments are held within the fund, so whatever these investments are, they are generating this interest, dividends, and capital gains. So the interest, dividends, and capital gains that the fund generates automatically get reinvested back into the fund. And this provides compounding growth now. So that as you have this interest, dividend, and capital gain accruing, they're going to be taxed to the investors. So this is automatically reinvested, this interest, dividend, and capital gain. All gets automatically reinvested. This is a process that we call a distribution. Now, that's part of what gives us this growth, this automatic reinvestment. On the other hand, you're going to have some stocks, for example, that our fund manager goes out and buys that just continue to appreciate in value. There's no automatic reinvestment then, that's just straight capital appreciation. Now, this ACB will be increasing over time because every time you have this interest, dividends, and capital gains, those amounts will be taxed to the investor. You'll get either a T3 or T5 each year that describes to you the tax consequences. That is, if the underlying stocks that your fund holds paid some dividends in that particular year, you'll get a T3 or T5 telling you that you have to pay that tax. Bonds as well. Every year you'll get this T3 or T5 describing the amount of interest income or the amount of capital gains generated by your bonds. And that will cause then your ACB to increase. That avoids double taxation because as your ACB is increasing, you're not going to end up paying tax twice on what is essentially the same gain. And this is a very normal process with a mutual fund. Now you can have a little bit of a gap here. It is possible to have a little bit of a gap when you get out. This gap comes from what are called unrealized gains or unrealized capital gains. And those unrealized gains would happen precisely because the fund manager went out and bought these stocks, for example, that have just appreciated in value, that have done nothing but grow in value, and she never sold those stocks along the way, so you never had that capital gain. You'll remember from the discussion around capital gains that capital gains are only a taxable event when you actually create a deemed disposition, when you do something to realize that capital gain. So for the most part, your ACB increases as the value of the fund increases, but there may be this opportunity right at the end here for your ACB to be a little bit shy of whatever the value is at distribution here, and that can create this situation with these unrealized capital gains. And this is much the same as what you'll see with the segregated fund or the IVIC that we're going to look at in Module 12. This taxation of a seg fund, taxation of a mutual fund are both very, very similar. So much so that, again, everything that I've shown you here is going to apply when we look at seg funds, except a little bit of the terminology changes, and with segregated funds you don't have the same opportunity for deferral of unrealized capital gains. So this is going to be very similar to the seg fund or the IVIC. All right, thanks very much. That's all we're going to talk about with respect to mutual funds. Enjoy your studies. We'll see you again soon.